Bluestone makes investment loans simple with competitive interest rates. Borrow up to 85% of the value of your investment property without paying lender's mortgage insurance, and no cap on existing investment portfolio size. Plus, personal Bluestone support from application to settlement. So don't wait to unlock your future. Bluestone, award-winning home loan solutions. Find out more at bluestone.com.au/investors. Lending criteria, T's and C's and fees apply. Credit provided by Permanent Custodians Limited, Australian Credit Licence 390183.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Oh, good day, everyone. How you going? Welcome to the podcast. Thanks for joining us. I'm Phil Tarrant, your host, and my job is to navigate conversations with people who invest in property or help other people invest in property. So two sides to the coin. Number one, we're all property investors, myself included, and I'm out there buying stuff and investing in property and trying to make it as good as possible. And I leverage a whole bunch of people to support me doing that. Some people choose to go it alone, and that's cool. And many of them listen to the Smart Property Investment Show to get greater insights into how they should be going about that more effectively. One of the key things we do, as well as speaking to property investors, is to get those professionals that support property investors make better decisions into the studio to give a sense for the market, give some idea of where, how, who, what people should be looking at any given time, and just giving some narrative and interpretation of what is a very complicated market. And, you know, I don't want to go into growth figures at the moment, but I think we're all pretty clear that property is pretty hot commodity at the moment. Some markets are performing much better than others, and part of my job is to try and identify from those experts where they are and why that is the case, but also effective buying strategies in a hot property market. And there's a whole bunch of people out there having a lot of challenges right now in terms of being effective. They're getting pre-approvals for home loans. They're excited to buy. They're all set to buy. They've got their deposit. They've got everything. Yeah, not able to find a property though. So it's a tough market, and it's going to be that way for quite some time. Join him in the studio today to try and get some sense of what he's seeing, how he's going about navigating this market is Lachlan Vidler. He's back in the show. He's director of Atlas Property Group. We had him on the show on the 25th of March this year. And it was very much Lachlan, the backstory of Lachlan as a property investor. And go and tune into it, 25th of March. You can find out whatever podcast player you listen to. But I thought I'd get him back in to actually have a look at how he's supporting his clients in this market, where he's buying, what he's buying, and any other information I can get out of him. I'm sure he's going to be pretty cagey. But Lachlan, how are you going? You well?
Yeah, good, Phil. How are you?
All right, mate. Now, how are you finding buying for your clients in this market? Is it easy or hard?
Oh, it has never been as challenging as it is right now, I think. What I'm seeing a lot of, well, I don't want to say a lot of, there's properties out there, right? And I think everyone knows that there's a lack of listings too. But a lot of the stuff that is out there is really not sort of what I'd call like an investment grade property. Mm-hmm. So it's so hard when you've got supply issues, and then what little supply there is often isn't the sort of thing that you want to help people invest in.
And give us some sense for this supply and demand type equation. So what you're saying is that even those properties on the market, not all of them, or probably only some of them, probably represent good buying. So one of the biggest challenges at the moment is a lack of stock. And you hear that all over the place. Agents are struggling to get listings. There's more coming on now, which as people start to see or think that we're sort of getting towards the top of the market. But what is on the market doesn't necessarily mean you should buy it, right?
Exactly right. I think particularly for this first half of 2021, there was a lot of vendors that ended up having quite unreasonable price expectations. And as a property investor, that's the first and easiest way to cull a potential property when, you know, you can no longer buy it with a good investment case behind it. And then, you know, when you can't do that, it's very hard to buy anything. And then even when you can find something that's reasonably priced, everyone pours into the market. And particularly people who are trying to buy to live in, so owner occupiers, they're happy to pay another 5K or 10K or more, depending on your property purchase price. And that's very hard for investors to beat as well, because we've got our numbers, and as soon as it moves outside that bracket, you have to pull a pin, whereas owner occupiers aren't so restricted like that.
Yeah, and owner occupiers who are buying now, and you must see, mate, you watch the results coming on the weekend, they're pushing prices way up over probably what market value is. And they're just thinking, well, it doesn't really matter if I pay over by 50, 100, 200, $300, $1 million now, in 2 years' time, I'm probably not going to be paying over is because it's probably equalized to where it is, but I just want to get into a place and they're not needing to sell. And that's the environment that a lot of property investors are operating in right now. It's not normal by any means.
No, not at all. And you're definitely right. I mean, it's been shown through a lot of the data. I mean, CoreLogic is coming out almost week on week talking about how owner occupiers have been driving up. At the start of the year, first home buyers were pretty prevalent in the market. And I think even they're now, that they're finding it difficult as well. Not that they don't ever, but I think particularly so now. But yeah, you're absolutely right. I mean, I would love to be a fly on the wall in a bank compliance room, looking at the risk of some of these places, because the prices people are paying, I get quite intrigued by banks being willing to fund it.
And that's it, and sometimes you've got to wonder, these properties that are going way overs, are they cash buyers? Now, there isn't that many cash buyers out there, because one of the challenges you have is if you choose to pay whatever you end up paying for a property, it's irrelevant what it is, but it's deemed to be over what the market value is. It's very hard to get debt on it. And have you seen yet many investors sort of falling foul of that? The valuations aren't stacking up at the point of securing a loan. Normally they'll finance it against a contract value, but if it's way out of kilter, the bank's not going to put that risk in there, are they?
No, definitely not. I'm seeing a little bit. I find the ones I see it from mostly are investors who are going and trying to do it themselves at the moment, particularly because they're so happy to try to get into something, and they're sort of taking the perspective, owning something is better than nothing, which I'd say quite often that's true. But in markets like this, it's not necessarily true, because you could be, pulling yourself out of 2-3 years worth of capital growth, assuming you get it, but 2 or 3 years of capital growth by paying over. And yeah, I've definitely had a few clients come to me and say, hey, we actually just tried to buy something, but we had to pull out of the contract because the bank wouldn't fund it. And that was just because they didn't quite have a good understanding of the market. They didn't have somebody behind them trying to support them in that. And they overpaid and the bank said no.
And it's such a dichotomy for real estate agents, because they obviously want to get the biggest price possible for the vendor. But if the price is over what the property is worth, the person that secures it, unless it's a cash buyer or they've got additional fat with deposit money, aren't going to be able to get the debt, and therefore the sale's going to fall through.
Exactly right. And I think it's really hard as well, because you look at one street and you can have, a couple of property sales going on, whether they're private treaty or auctions. And as soon as one property sells on that street, that then sets the tone for the rest. And the vendors will come in and they'll say, all right, well, this property sold for X price. I now want an extra 10,000, or I want an extra 100,000, or I want an extra couple 100,000. I actually had a very interesting situation probably 6 weeks ago where it was the opposite. We were buying for a client and we were looking at a property, and I have a really good relationship with an agent working in the area, and he shopped it to me pre-market. And little did he know, or me, the very next day, the property next door went up for sale, carbon copy property, went up for sale next door. The vendors had to sell. So it was priced probably pretty close to 70 to 100,000 below its market value, because they just needed a fire sale. Fortunately, we were able to come in and snap it up. I think my conservative estimate is probably 40 to 50,000 under market value. And that's now the sale. So the agent who I was originally going to buy a property through that had a reasonable price on he's now having to wait about 6, 7, 8 months probably, because otherwise he's going to get caught up with the comparable right next door.
Yeah, because people go, well, it's not worth that much because that one there. And the sort of backstories to property is not always what you seem. And to the point, it's a very tough market to be buying in effectively as a property investor. That's not to say you can't do good buying in this market. And we've had some great stories recently of people who have done exceptionally well operating in this particular market. But this sort of whole notion, Lachlan, of building your property portfolio in 2021, the key question to ask is it really the best year to be building a property portfolio? Should you sit it out?
Interesting question. I think I like the adage, the best time to invest was yesterday, the second best time is today, and the worst time is tomorrow. I think no matter what, it's a really good saying to base your investing off. And I think in 2021 particularly, it's not that it's a bad time to invest. You just have to be very, very careful, particular and specific about what you're doing, because the window or margin for error, where it's usually quite a bit wider, you could say you're going down a freeway that's got 4 lanes. Nowadays, you might be going down a one-way street. And if you go too far left or right, it can really hurt your overall portfolio building into the future.
Yeah, so let's have a chat about how you do buy effectively this market. And I take the point that you're saying you should still be operating in this market. It's still a good market to be building your portfolio in. You just need to use your analogy, stay within the lanes, and the lanes are getting narrow. We'll just go to the break beforehand. Stay with us. When we come back, we'll get into it. Back in a moment.
Whether you're a seasoned property investor or about to buy your first property, finding the right investment property to buy in 2021 isn't easy. Why do it alone when you could partner with award-winning buyer's agent Paul Glossop? Over the last 10 years, Paul has helped hundreds of clients build multi-property portfolios. Paul's secret is finding off-market bargains that get snapped up before the general public even gets a sniff. Interested? Head to purepropertyinvestment.com today to schedule a strategy call with Paul Glossop.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. I'm with Lachlan Vidler. He's the director of Atlas Property Group, and you haven't seen it yet. We've teamed up with Lachlan and his crew over at Atlas to make available a couple of really cool spreadsheets to help you on your way to invest more effectively in property. And you can only invest effectively in 2021. We're talking about building a property portfolio in 2021 by knowing how you sit right now. And over many years, we've created a tool that we use here at Smart Property Investment to manage and map our portfolio, which we're making available in conjunction with Lachlan, some of the stuff that he's got. So it's just a free tool that you can download from smartpropertyinvestment.com.au. If you go to the homepage, you'll see a big button that says download the Smart Property Investment spreadsheet. It's really cool. I have on good account that it's a pretty good spreadsheet. I'm going to say that. I sort of, and a team here, we made it, but multiple different accountants have used it as a way to consider our portfolio. And they say it sort of gives you all the key, important and pertinent information. Maybe too much if you're new to property investing. There's quite a lot of info in there, but it gives you an asset level point of view, a P&L point of view, and a balance sheet point of view. So you can go and download it, smartpropertyinvestment.com.au. We've done this in conjunction with the guys over at Atlas Property Group. You can't miss it. It's on the homepage. Hundreds and hundreds, if not thousands of people now have probably downloaded this thing. So if you haven't got something or you want to see how ours stack up against yours, feel free to go and download it and let me know what you think. Now, Lachlan, to that point, you need to know what's going on in your portfolio today before you can effectively invest in property tomorrow. Are the people coming to see you over at Atlas, are they ready to go? Are they planned and prepared? Have they got everything sort of lined up and know their base position, or is some people wanting in that regards?
Definitely both. I'm finding at the start of the year, people were a little bit less prepared. And I think with all the media coverage at the moment, I mean, you open up the AFR, you open up any of the major newspapers, and I swear to God, every single day there is some brand new article about property and whatever tone they're striking, but it's always about property, how hard it is right now. And I have noticed that people are coming a little bit more prepared. More people are coming with, say, pre-approval already. And if they don't, we obviously help them to do a pre-approval. But people are coming with things like that. People are coming with structures already established if they're going to be purchasing outside of their personal name. So there's a little bit more preparedness, which is good and bad. I mean, it's good in the sense that you can pull a trigger a lot faster, but it can also be bad in the sense that if they've done what they think is right, but they've done it without a bit of help and guidance along the way, they may have actually put themselves not in a good position, and they might need to go backtrack and fix up a few things before you can proceed.
So when you're looking at investing in this particular market and, goal setting or looking the levers to support goal setting, cash flow, equity, these other factors, how are you sort of helping people shape their goals for 2021? I imagine you're going to say, it depends on where they are on their investment journey, whether they're new to the game or they've got 50 properties, because you're going to have different strategy and different tactics connected with that. But what are those realistic goals when you're looking at 2021? And we're sort of halfway through it already.
Yeah, absolutely. I think before I tell you what I think my realistic goals are, I want to give a bit of context to why I thought it'd be really good to have a chat about this portfolio building in 2021, because I think for people who listen to SPI, everyone knows it's so hard to build out right now. And everyone knows that since lending changes came in, particularly in the early 2010s or mid 2010s, everything just got so much harder. And now you see things like property prices are making it that level harder again. And I've actually just finished writing a book that's being published in September with the guys over at Major Street Publishing. And for me, writing that book was about what is it that are in property books right now that don't really reflect the times. And I think that a lot of people will be able to empathize with that you go pick up a property book from, a Dymocks or an Amazon or whatever, and you buy it, and it's not necessarily as realistic or current as you might expect. Some very common ones are you go live off equity. You just constantly bring out lines of credit and you can live off that. Whereas it's not quite so practical these days. So when we were coming in to have a chat today, Phil, I thought, what would be a great thing to talk about? And that's that building a portfolio. And for me, I'm basing this discussion, the book as well is based off that. Just your average, typical Australian, maybe they're a teacher, maybe they're a tradie, maybe they're a nurse. They could be a young professional. And it's hard because your ability to borrow is so restricted. So I think that the biggest things that I say to people when we're looking at realistic goals are, if you want to build a 10 property portfolio in 5 years, I've got bad news for you. You've got to raise your income probably 4 or 5 times, or we bring those goals back a little bit to be a little bit more realistic, because it's going to be hard. It's going to be really, really hard. And to do it, you either need more money or you need to take on more risk. And both of those things often aren't quite palatable to people, because it's not so easy to go and get an extra 100,000 salary. And people also don't want to go and take on a massive amount of risk. So for me, broadly speaking, I think realistic goals and starting in 2021 are get in, start. If you don't have a property, buy that first one. If you can't do it yourself, get a professional to help you. Get a buyer's agent. Don't necessarily trust the family around the barbecue, because there's a lot of misconceptions out there. But just get that first one, because the first one is the hardest. And then from there, we can start building out. Like you said, and I do have to say, it is going to depend on where you are and what you want and your goals and things like that. But just getting that first one is a really realistic goal for 2021. And if you have one, get your second if you can.
So what's the new book called, mate? You got a name for it yet? I didn't know there's going to be a book plug, but, the world needs more property books.
So drawing on my background coming out of the military and then the business world, I decided to put a different flavor on some of these property books that are out there. And it's being called A Military Guide to Property Investing. So It's a military guide to property investing. And the subtitle is A Step-by-Step Guide to Conquering Your Goals.
Pretty good. So how different is the market today that you're writing this book into what it was, a year ago and 5 years ago? I think largely some of the fundamentals remain the same, but the application of those fundamentals or applications of those principles is probably where it differs. And no doubt that probably lends itself to your military training. By memory, you're a naval officer. Were you in logistics?
Yeah, I was in warfare and logistics. Yeah.
Warfare and logistics. So you military people, there's normally sort of doctrines that you follow, but it's how you apply them. It probably specific to the situational circumstance that you find yourself in. So this is what you're sort of focusing on in your book, is it?
Absolutely. I think, like you said, the fundamentals are exactly the same, right? Property prices, for example, is supply and demand. If there's more supply, then prices stay the same or they go down. And if there's more demand, they go up. So, it's a very simple way to describe one of the concepts, but property investing doesn't change. Everything that you need to see stays the same, but the application is what people need to adapt to. And I think going to your question about what's different between last year versus 5 versus 10 years ago, I think that the big ones are people's ability to borrow. Back in, say, the very, very early 2000s or late 1990s, lending was almost like a tap that couldn't be turned off. If you could buy a property, if you could find a property and it was renting for a pretty reasonable amount, you'd almost get unlimited.
They couldn't give it away fast enough.
Exactly right. And it was perfect. That's how people went and built portfolios of
103% mortgages.
Exactly right. 5 or 10 properties down in Bondi Beach. They've let, the lending stop now, but they've still got those properties and, they're now worth $20, $30 million. It's fantastic, but you can't really do that anymore. So I think that was one of the really, really big changes. And then I think past that, people have found that debt to income levels are also rising. So that's also playing into the borrowing capacity a little bit. And there's all these small nuances that just are making it difficult to apply the principles in the same way. Because again, the principles don't change, but just the way that you apply them has to shift over time.
So when you're investing in property, do you actually leverage the discipline of your military training to give you, I guess, pathways or processes for decision-making and getting better outcomes?
I like to think so. I think probably the big one is discipline. The amount of times I have clients come to me, they sign on, we're going through the process, we're finding properties, and it takes that discipline to be able to go, guys, it's not possible what we're looking for today because it's not on the market today. Tomorrow it could be, but we all just need to take a breath and realize that buying something that's wrong is not the solution. To do it fast is not the solution. We've got to wait for the right one. So I think a bit of discipline coming with that. And I think a lot of property investors can sympathize or empathize with that as well, because it is hard to buy, exactly like we're talking about at the start of the show. And I think probably the other really big one is bringing in processes. I'm sure a lot of small businesses out there will know that when you're trying to set up a business or when you're running a small business, it can be the processes which can make your business a success or a failure. And I think that the military really set me up well to be able to have great underlying processes and principles to ensure that we can operate effectively.
Yeah. And the thing is that, a lot of people go, oh, processes and systems, that's pretty boring. But what it do is it gives you the scaffold to ensure the predictability of outcomes. So, if you follow a particular way of doing stuff and it works, you're largely guaranteed that you'll get the outcome that you want. Now, if you follow a process and it doesn't work, you go back, fix the process so you can get the outcome that you want. And it's very similar in property investing. All the best property investors I know are very process driven. They're very systems driven. They're very outcomes orientated. But it's a whole adage of routine will set you free. Get the routine right and just keep doing it the same every single time. And guess what's going to happen? You're probably going to get a much better outcome. Now, talking about goal setting for 2021, Lachlan, and I'll subscribe to a lot of your thoughts there on the realities of investing market is very different. Fundamentals, principles still the same. The application of them need to change and evolve and different with an eye towards the future as well, i.e. we don't know what's going to be happening with the federal election, which is probably going to be happening early next year. Don't know what's going to happen, negative gearing, blah, 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 blah. A lot of things we don't know. And another military term, a VUCA environment. You've come across VUCA, Lachlan?
Yep.
Volatile, uncertain, complicated and ambiguous. Look it up, Google it. It's not a bad mantra for decision making. It just pretty much goes, there's a lot of stuff you don't know, but use the stuff that you can and do know and make your goals around out. So goal setting around cash flow and equity. What's realistic with these right now? And equity, goal setting around that, like unless you buy the worst property in Australia in the worst suburb, you're probably going to get some equity growth, right?
Yeah, I would say that's probably a fair comment right now. For me, the way that I tend to look at it is your traditional property investing camps. You've got on the far right, cash flow investors, and on the far left, capital growth investors. And that's the capital growth is obviously going to be your heavy negative gearing where you're buying houses down on Bondi Beach and you're 2% yields, and then cash flow investors where you're buying possibly in the middle of nowhere, but you're getting 8, 9, 10% yields. So I think that's the spectrum. I'm not going to call it 1 to 10 because they're not better than each other, but that's sort of the left and right. And I think these days, particularly, if you're going to draw it on a line, you probably want to be in the middle, slightly, very slightly. Like if you did have numbers on it, it might be say 4 to 6 or 4 to 7, being the 1 being cash flow and the 10 being equity. 4 to 6, 4 to 7 in that range. Because I think at the moment what do they say? Cash flow keeps you in the game, equity gets you out of the game. So you can't, if you focus too far to the cash flow side, you're going to be on a wheel forever. And if you focus on the equity side, you're going to buy 1 or 2 and then you're done. You're going to be done for 10 years. So I think sitting in that nice middle or fractionally to the side of equity means you're going to build that equity out. Even when this market starts to cool and it's on a more normal pace, you'll build that equity for your future, but you'll have enough cash flow to keep borrowing, which is so important because if your cash flows are off, it's very hard to keep getting money from banks or lenders. I typically say to people, if you aim for about a 4.5% yield in the current environment, you'll probably be neutrally geared, about that mark. And so if we can target a 4.5% yield moving up all the way up to maybe a 5% yield or 5.2% yield, you're probably going to be in a nice sweet spot of still being able to get equity. So you're still in really nice locations, but then you're going to have enough cash flow to keep borrowing.
Yeah. And I think it's okay to, a lot of the times the market will dictate where you sit within those parameters. What will also dictate is your particular circumstances. So negatively geared or positively geared for one person doesn't necessarily represent the same for another person. But it's okay to shift. It's like a metronome that sort of moves left and right. You can do it sort of on a property on and property basis. My base assumption, I agree with you, would be you should be leaning towards or have a bias towards capital growth in this market, because what will happen is that when that capital growth runs out, there'll be a natural equilibrium where it will shift back to yielding properties because there's less selling and there's less happening in the market and there's more demand for rental properties, blah, 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 blah. It's 101 stuff. So, yeah, I don't mind how you're sort of framing that. I'd be operating at sort of 7 and 8 at the moment, personally, towards chasing capital growth because cash flow I have in the balance, right? Like I'm happy to wear a little bit of negative cash flow on the basis of amplifying that negative cash flow multiple times by chasing equity in an equity market. So that's where I'm at, but it's going to depend where you are on your journey, right? If you're new to property investing, I'd probably say chase right now as much equity as possible.
Yeah, I totally agree. I think the metronome is a really good one, is a really good analogy for it, because you're going to come left and then you're going to bounce right and you're going to keep doing that as over your entire property investing journey. So I think it's a really good analogy. And I also like what you said about that it's different for each person. Like, take yourself, for example, you can wear that little bit of negative gearing or negative cash flow at the start because of your position. And that's really good. And I think it's awesome in a market like this. But then you've got some other people, I guess, going back to when I was talking about the book and how it's sort of designed for that everyday Australian, you could have a teacher who doesn't really earn, hundreds of thousands of dollars a year. So for them, buying one property is a real step up. It's a real challenge for them. And they do have to swing a little bit more towards that cash flow side to be able to maintain it. So I think it's a really good analogy, but I'm seeing it all the time. We're, buying a property, say it could be a $500,000 property. It's got tenants in it right now, and that property's tenanted for, say, $350. So you do have a big gap right there, $350 a week. But the market rent might be closer to $450 or $460. It's just that you've got a tenant on an older lease. And that's what we're seeing in the market right now, is a lot of that. And I think you're right that once this capital growth period really starts to settle down, those rents are going to come back up. So if you can wear some of that hurt, there are some opportunities to get some big equity gains. But again, it's really just going to come down to, your personal circumstances. What can you do?
And there's 2 points I want to make, Lachlan. Number one is this is not about who can have the most properties, this podcast. To give some context, most Australians, by most, I mean nearly every single Australian investor, only ever ends up with 1 to 2 properties. And that is a product of a whole bunch of things. One is maybe when they started investing in property, or number 2, their retirement plans, or number 3, their income earning potential. It's okay and it's good to have 1 to 2 properties. 1 to 2 properties can, done well and done early, can set you up for a very comfortable retirement. So it's not about trying and get as many properties as you want. And, this is what you got to focus on all the time. You are unique. You need to make sure you're staying within your own lanes, and don't peg yourself to other people's property investor. Your chapter 1 is very different to other people's chapter 10. And a lot of people get obsessive with that. Do you see that when people come and see you, Lachlan?
Oh, definitely. Definitely. I've got people that are coming to me saying, hey, my neighbor, my friend, my mate, whatever it is, they bought 3 properties this year, and we're in the same job. We earn the same money. I want to do the same. And then it's only when I sort of can dive into their circumstances, that's when you start to find out the differences. Maybe one person's got 3 credit cards, a boat debt, and a car debt, whereas the other person doesn't. They've got nothing. They literally earn their money. They live in a very cheap apartment or a house, and they put all their money towards investing. But you never know those things because nobody talks about the hard parts of their investing journey. Nobody sits back and goes, I ate 2-minute noodles for 6 months so that I could get my first deposit. People don't talk about that because it's not the fun, sexy part. But you're right, everyone's journey is so different, and you often don't see those different parts of the journey. You just see that surface level part.
Yeah, well put. And we try and give a bit of a real world view on this particular podcast, where I'll talk a little about Maggi noodles. And, I lived on Maggi noodles, not to become a property investor because I spent all my money on booze when I was a backpacker. But anyway, that was it's a really good apprenticeship. Now, the other point I would say to balance that particular positioning is every single property investor I speak to, when I say, what would have you done differently if you had your time again? And they would all say, I wish I bought more property when I could have bought more property. And when you consider this market, and there's a lot of just free pass equity in this market right now. When I kicked off, we rode the wave of a booming Sydney market, and that set us up and our portfolio up for really good long-term positioning, but also equity to leverage and grow it. So, get your mindset right during this market. Be as conservative as you're comfortable being conservative. But I tell you, if I ask you in 5 years, anyone, what you wish you did more during this market, I bet you everyone will say, I wish I bought more property.
You're right. But how good's hindsight, right? You look back, it could be 20 years later, and you look back and your whole perception of the world is so different to what it was when you were, 20 years younger, for example. And I think it's really good, and it's really easy to sit back and say that. And I've had people come and say that to me all the time. They come and they might be in their 40s and they go, oh, I bought my first property when I was, 21, 22, 25, whatever it is. And I sort of stopped. I thought I'd made it. I then went and spent my money on cars and holidays and fun times. And I wish I didn't do that. But I think people sometimes forget, you are the aggregate of your experiences. So even though you might not have 3 more properties, you've got all these life lessons that you've now learned. So I think that there is silver lining in everything. Maybe those experiences that you paid for rather than buying property set you up to be ultra successful in a 5-year window when you're in your 30s. You never know. And I like to think that, embrace where you're at and where you've come from. And then that way you'll just be able to make the best out of the situation that you're in.
Yeah. Embrace your own story, embrace your own narrative, but don't be, you see this new phenomenon called, what's it? Central character syndrome now, where people Google it. It's pretty disturbing. It's a social media thing where people think they're the main character in their own story, and they think that life. It's a social media thing where they think they're in a movie, right? It's central character syndrome or something. It's pretty bad. Go and look at it. Don't become that. But this has all been quite sort of philosophical, Lachlan. So I want to get down into the realities of buying in this market. We'll just go to another break. Stay with us. Back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show, with the director of Atlas Property Group, Lachlan Vidler, who has a new book coming out. When's it come out?
September.
September.
Yeah, I'm just finishing up with the final edits now. So our publisher, they've done some pretty big property investment books.
Yeah, we know those guys.
Yeah, Major Street. Yep. So they did like Armchair Guide to Property Investing. So it was really, really great to partner up with them. And it's coming out in September. So we bookstores online, like Amazon's and all that. So it's really exciting. Really, really exciting.
How have you found that process of, they reckon everyone's got a book in them at some point. Would you do it again? Too early to ask?
It's a great question. I mean, I've done a lot of study myself, so I think that I really enjoy stimulating my mind in sort of an academic sense. And for me, doing the book, I will say I did co-author it with my partner, which was another interesting dynamic to add into it.
How'd you split it up? Did you do a chapter each, or how'd you do it?
We just sort of looked at our strengths. So, I'm really good on the technical side and things about, property, in the sense of, how do you look at the maths behind it and things like that. So I was really good at that. And she's got a really good creative brain. So she was able to do some of the more thinking chapters, I guess you could call it, a bit, like mindset, for example, things like that. So we just sort of, leveraged off our strengths and split it up. And we ended up splitting it pretty close to down the middle, I think. That's cool. And probably an inappropriate question, but I'm going to ask, are you guys married yet? What's going on? No, we're not married yet, much to her displeasure, I think. But
make a few more bucks, buy her a bigger ring, mate. But but if you're able to, what I was going to say is if you're able to write a book together, mate, it's probably not a bad benchmark for a happy marriage, mate. If you can meet in the middle there, so it sounds all right. Not that I'm a marriage counsellor, definitely.
Don't ask her about that. She's already said she'll never write another book with me. We've got very different work styles, so
okay.
She said she won't do it, but maybe we'll both individually do another book each. Who knows? Maybe, but it's a really good start. Now, tell me, asset selection. What do you like at the moment? Where it is? I don't want some flippant answer going, houses in growth locations. Give me something good, because I know our listeners are sitting there going, that's all good. Just tell me where should I be buying right now? What about I just say property in Australia? Is property in Australia? anywhere in Australia. Throw a dart at a board. No. Look, I think it's, there's lots of considerations. And I think, going back to what we've spoken about at the start in terms of like cash flow versus equity, I think there's a few considerations there as well. Like, maybe at this point you want to be getting into some commercials, for example, or maybe you do want to stay residential. So I think there's lots of different things to pull into the bucket. But for me personally, and for my clients at the moment, very heavy on the houses. I'm not a big believer in apartments. I mean, obviously take that with a grain of salt. If you have a beautiful apartment penthouse on Sydney Harbour, of course it will probably do quite well for you. But generally speaking, I'm not a big fan of apartments. I think the land that you get out of houses is obviously the value of the house or the property. You can do a lot more to a property where you own the land. You don't have to deal with strata or owner's corps, things like that. So big believer in houses, big believer in established. I think the really scary side of property booms is new housing development and how it comes out of the woodwork. And, for the listeners out there, feel free to send me angry emails if you disagree with me. But I am not a believer in any way, shape or form. And I'll even go so far as to say, regardless of personal circumstances, of buying brand new off the plan or house and land packages. I don't subscribe to it. I steer my clients as far away from it as possible. And if you want to send me an angry email about that, please feel free. I'm happy to have a robust conversation. But for me, the really, really big one that I say to people is supply and demand. You go buying these big estates, developers control the stock and the release of stock for 20 years plus. As soon as property prices start to go up, they'll release more stock and it will cool it. So you have pretty much no control over that market, and any growth you get is almost artificial in that sense, because if they throw on a lot of stock at once, that could devalue your property or stagnate it for a lot of years. So that's the big one I say to people in terms of that. In terms of locations, again, this is probably where it comes to a bit of, each to their own. But I think for me at the moment, particularly, again, coming from that everyday Australian perspective, we're not talking about lawyers that are earning hundreds and hundreds of thousands of dollars and have hundreds of thousands of dollars in the bank as well. I'm talking your everyday typical person. Regionals are going fantastically at the moment. You look at CoreLogic, and I can't remember off the top of my head what the last numbers were for, what are we in, June? So it would have been May. I think that year to May, it was something like 15% growth in regionals, which is amazing. That's fantastic. And obviously not every regional is the same, but for your properties that where you're only able to buy, say, a $300,000 to $500,000 or $600,000 property, there are some phenomenal plays out there. Absolutely phenomenal plays. You get good cash flow, great equity, great value add opportunities as well for when the market does start to level out and your neighbor's property is not going up because they're just sitting there on it. You can do some things to yours that can keep having some of that growth. So I think that there are some absolutely phenomenal large regional plays. And I do emphasize that. I'm talking, places that might have 50,000 plus people, for example.
Yeah, all really good. Now, should you be chasing stuff where you just getting a free run, like buy well and just ride the equity, or is it worthwhile actually looking to see how you can add value? Is it worth adding value during this particular market? And by adding value, you can talk about doing cosmetic renos or more structural renos, and or chucking granny flats on, and or knocking stuff down and doing developments right now. And, people like the idea of developing, but developing is very expensive in this particular market. Not a lot of materials around. It's hard to get it in because of COVID. Tradies are super busy, prices going up. It might not necessarily be the best time to be doing that. Thoughts?
I'd probably agree. I think right now, particularly like a hardcore development, like knockdown rebuilds or building sets of apartments out the back of a place or something like that, or even just a second dwelling. Yeah, very, very difficult. But I think regardless of any market, you should definitely try to buy with a value add type of mindset, because it does, to me, and I say it to clients all the time, it doesn't matter if you do it on day one or you could do it in year 10. It honestly does not matter. You've got the option, which is the best thing, because you can choose, because there's nothing worse than not having the choice. And I think, like exactly as you said, you can start very small, like a cosmetic type stuff, which could just be paints and carpets, up to structural, like adding rooms or adding on wings or things like that, all the way up to your full development. And I think it's fantastic because the market's going to cool. Anyone who thinks that this market's going to go for forever, I hate to burst your bubble, but the market will cool. And when that happens, if you've been able to buy very strategically and have something like a value add opportunity right there, sitting there, like I said, your neighbor's property is not going to go up, but yours can, which is great. And you can manufacture that equity. And, I see a lot of people buying up in Queensland now, particularly, around that greater Brisbane area. It's been the dark horse for probably 10 years, I'd say. Everyone's always thought it's going to go up, and it's definitely starting to see some movement now. And, you can get the best of both worlds there. You could buy in a capital city with really, good pricing and also have value adds, if you're not a regionally inclined person. So, that's a really good opportunity. If you try and buy in Sydney right now, probably going to struggle. You're probably going to be very negatively geared. Actually, I would say you will be very negatively geared. So it might not be the play for a lot of people. So, yeah, I guess going back to the heart of what you're saying, the value adds, I think where you can, it's an option. Why not?
And is there such thing as under market value properties in a sort of hot property market?
I think it's a shifting scale. It's under market value. It's a concept that I've spent a lot of time trying to work out my views on it. I think it's a nice catchword. And I've spent a lot of time thinking about it. So I'm not a property valuer, but I've done a lot of the same education, like master's level study in property. So that's all about trying to understand the valuation side of property. And there is actually a term, which is market value. And often it ends up being, an arm's length transaction. What the property pays for is market value, right? But that's where it becomes an interesting concept, because you can look at your comparables, which are market value. And if you compare yours to them, there is that possibility that you can get market value. Now, I would say if you're talking, it's going to be relative to purchase price, but if you're talking like a 1% difference or 2% difference, I'd probably call that a rounding error more than anything. But when you're able to look at it and very easily say, like, here you go, here's a 5%, here's a 10%, here's a 15 or 20% difference, I think you can say that, that's an under market value property.
Cool. I think we've done pretty well there today, Lachlan. Covered a lot of ground.
You think?
Oh, yeah, I think so. I look forward to your new book, mate. Check it out in good bookstores from September.
Right? Should be.
Yeah,
should be. Assuming it prints on time.
Assuming it prints on time. Well, printers love printing stuff, mate. So I can guarantee that. That's cool. And thanks for partnership with the release of the Smart Property Investment spreadsheet as well. That's hugely popular. Remember, go to smartpropertyinvestment.com.au and download it. There's also something from you there as well, isn't there?
Yeah. So, I mean, along with the SPI, or Smart Property Investment spreadsheet that you get, we've also thrown in our own client portfolio spreadsheet. So for us, it's a really great tool, and you're able to put your own properties into there. You can add more, you can add less, but it gives a really, really good snapshot, and it's very future focused. So it's about, if I buy a property and these are the assumptions we make, this is how our portfolio could look over 30 years. So really great tool, colorful. If you like using spreadsheets and you're a numbers person, hopefully you'll enjoy the spreadsheet. We've had a lot of good feedback from the readership and listenership. So we welcome any and all feedback, and we hope you enjoy it.
That's cool. It sounds very different to what we've got, which is quite sort of, it's not giving you long-term forecasting growth and stuff. It's about the realities of your portfolio at any given moment, so you can make more informed decisions. But yeah, thanks for joining us today, Lachlan. Always enjoying catching up and stay connected. People seem to like you on the podcast, so we'll have to get you back in again.
Oh, thanks, Phil. It's always a pleasure coming in, and I'll be happy to have a chat with you whenever we can have a chance.
That's cool. Lachlan Vidler, Director of Atlas Property Group. Hope you enjoyed it, everyone. Remember, all that stuff, smartpropertyinvestment.com.au. If you follow us on social media, if that's how you like to get your info, Smart Property HQ is where you want to go. One favour for me, please, and I don't really ask for a lot on this, but the team get a real kick out of those reviews coming through, whichever player you listen to your podcast on. 5 stars is good if that's what you think we're worth, and please, those comments as well, they go a long way to keeping our team connected and happy and doing what they do so well. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Bluestone makes investment loans simple with competitive interest rates. Borrow up to 85% of the value of your investment property without paying lender's mortgage insurance, and no cap on existing investment portfolio size. Plus personal Bluestone support from application to settlement. So don't wait to unlock your future. Bluestone, award-winning home loan solutions. Find out more at bluestone.com.au/investors. Lending criteria, T's and C's and fees apply. Credit provided by Permanent Custodians Limited, Australian Credit Licence 390183.